Are you sure you are competent enough to file your tax returns for 2025? I want us to do a simple test to confirm exactly that. Just like a police officer would request a person they consider to be highly intoxicated to get outside the car, stand on one foot, and if they are able to maintain the balance, they are good to go. If they are not, they are advised not to drive because they are likely to cause a fatal accident. So the same question, are you confident that you are competent, skilled to file your own tax returns for 2025? A simple question. Let's assume you are a mama mboga. You go to the market very early in the morning, you buy sukuma wiki worth 500 shillings. And at the same time, you buy a knife worth 100 shillings. You go to your Kibandaski, your greengrocer shop, and you are very lucky. Before the end of the day, you succeed to sell all the sukuma wikis and you have a revenue of 1,000 shillings. So the question is very simple. How much is your profit? You went to the market, bought sukuma wiki worth 500 shillings, and at the same time, you bought a knife worth 100 shillings. You are very successful. You sold everything, all the sukuma wikis at 1,000 shillings. The hint is, profit is computed after deducting expenses from the revenues. So, what is your revenue? It is not in doubt. It is 1,000 Kenya shillings. But your expenses, 500 Kenya shillings that you incurred buying the sukuma wikis that you sold, 100 Kenya shillings that you incurred buying a knife. So perhaps your total expenses is 500 plus 100, that is 600, and therefore your profit is 400. Is it? Sure? No. The profit for mama mboga for that day is not 400 shillings. And I know this is something that takes many people off guard. The profit for mama mboga is 500 shillings. When we are computing profits for mama mboga, we do not consider the cost of a knife as an expense for the day. Why? Because a knife is an investment. It is an asset, something that will help mama mboga to generate more incomes in the future. When computing for profits for the day, for the case of mama mboga, you only consider the cost that were wholly and exclusively used to generate that income of that day. Of course, I have simplified this case. I have not mentioned about transport cost, the labor cost for mama mboga. I have put a very simple case because my point was to ask you, do you know that the cost of 100 shillings that the mama mboga has used to buy a knife, it is not an expense, it is an investment because she has used a knife is an asset. And you can be very surprised that many people, they don't have a clear understanding what expenses are deductible when computing for profits. The only expenses that you are supposed to consider are those that have been wholly and exclusively incurred for purposes of producing or generating that income. In other name, we refer to those expenses as operating expenses. If you like, you can call them OPEX. This could be rent, transport, fuel, salaries, the stock that has been sold, not the stock that has not been sold. If it is the stock that has not been sold, that's a different story. It is also somehow an investment. It is an asset because it's something that you will sell in future. That stock that you have not sold, it has not helped you to generate that income of the day of 1,000 shillings. So the operating expenses are the day-to-day normal running expenses for the business. Any expense, and for that matter cost, whose benefit will be enjoyed by the firm for more than a period of 12 months, it is not an expense for that period. The period could be a day, like for Mama Mboga. It could be a week, a month, quarterly, or a year. But the point is, for an expense to be considered deductible when computing for the profits, then it must have been wholly and exclusively incurred for purposes of generating the income of that period. Now, we have another set of expenses that are referred as capital expenses. Capital expenses, in other words, you can refer to them as capex. These are expenses whose benefits will be enjoyed by the firm, by the business, for more than a period of 12 months. You buy a knife. If this knife is durable enough, it will not only serve for 1 year. It will serve for maybe 2 years, 3 years. Whenever it gets blunt, then you have to sharpen it. But it is an investment that will be used by the firm to generate future incomes. Think of something like a laptop that you buy for purposes of doing academic writing or for doing tax returns. If you're a consultant like me, then what that laptop is not an expense for the year that you have bought it. It is a long-term asset and therefore an investment to you. You don't consider it as an expense. Maybe what you do is you consider this laptop, for how many years will I use it? For how many years will it still be in usable status? Now, if you say it is 5 years and this laptop you have bought it for 50,000, so the only cost that qualifies to be deducted in the first year of buying this asset, this laptop, is 50,000 divided by 5, and that is 10,000, because every year you will be recovering 10,000, 10,000, 10,000 until by the 5th year you have recovered 50,000 to enable you to buy another computer. Think of it like a piece of soap. When you use the soap, it reduces in size. The amount of reduction in terms of size, maybe this soap was weighing 500 grams, and after you have taken a shower, it now weighs 400 grams. It's just an example. That reduction by 100 grams is what you can consider as the cost, part of the cost of that soap that has been used wholly and exclusively for producing the income of that period. So for the laptop that is worth 50,000, you may not see, but the value has reduced from 50,000 to 40,000 at the end of the year. And that reduction in value is now what you'd consider as an operating expense. Think of motor vehicles, other machineries, you do a building. If you do, those are not operating expenses. They are capital expenses referred by another name, capex. If people were to deduct the expenses that they incur of that nature, then most businesses would forever be in a loss-making position. Remember, as the business grows, the business starts small, then with time, they continue buying more assets, investing, buying more resources, building, buying land, buying more motor vehicles. If all those investments were to be considered as expenses for the year, I'm telling you, most companies would continue to suffer loss. And can you imagine if the company has suffered a loss, or maybe it's we say this mama mboga decides to buy a motorbike. Let's see, this mama mboga is a very adventurous one, and she understands that a motorbike would do her so much good in terms of reducing the transportation cost. Now, the motorbike is worth, let's say, 100,000. And this mama mboga, for instance, for the sake of this example, let me say the mama mboga is making a profit of 10,000 only in a year, for the sake of this example. Remember, if mama mboga has bought this motorbike at a cost of 100,000 and the profit for the year was 10,000, then the whole profit will be consumed by the cost of this motorbike, the entire profit. So this mama mboga is likely to report losses for the next 10 years, because assuming the mama mboga is getting a profit of 10,000 per year, and then he keeps the cost of a motorbike of 100,000 that was incurred in the first year, it was the first 10,000 as profit was offset against that cost of 100,000 for the motorbike. The loss position as at the end of that year was 90,000. So the second year, mama mboga makes a profit of another 10,000. Then they don't pay taxes because they had a loss brought forward. The loss brought forward from the previous year was 90,000. So if they were to make a profit of 10,000, reduce again. So the loss keeps reducing by 10,000, by 10,000, by 10,000, by 10,000 from 100,000. And if that was the procedure, this mama mboga would only pay taxes after the 10th year. But the good thing, that is not the case. You only deduct not the entire cost of that asset, but only the part of the asset that you feel has been consumed in that particular year. Like the case I've said for the soap, as it reduces in size, that's how you know that a part of the soap is getting consumed every other day, every other time you take a shower. Now, but for purposes of filing taxes, it is not you to decide what reduction, what part of the entire cost that you incurred in buying that motorbike you will be deducting from the revenues that you have generated in a certain particular year. KRA has provided a guide. We have wear and tear deductions, where KRA tells you if it is this type of a machine, this is the way you depreciate it. Whether it is a heavy lifting machine, whether it is a motor vehicle, whether it is a building, there are specific rates, and those are the ones that you are supposed to use for purposes of preparing the taxes payable. But if it is for the accounting profit, you can use whatever the rates that you want. So operating expense, capital expenses, they are long-term in nature, and you don't recover them 100% the moment you incur them. You recover them in a piecemeal manner. A portion of it is what you convert to operating expenses so that it can be deducted from the revenues of that particular year or period. So back to the basics. Did you answer the first question right? Whether the mama mboga was supposed to have a profit of 500 shillings or 400 shillings. If you said that the mama mboga had a profit of 400 shillings, then you need to really prepare and research and consult before you file your 2025 taxes. Because one wrong mistake today would be your worst nightmare tomorrow. To summarize, revenue, maybe there's not much problem according to that example that I have given. But sometimes even the story about revenues gets complicated especially if there is someone who paid Mama Mboga in advance for the supply that Mama Mboga is supposed to make the following day. Now, there it becomes a bit tricky. But for the question I had provided, it was Mama Mboga going to buy sukuma wiki of 500 shillings and selling them at 1,000, and then there was a story about a knife. So a knife is an asset. If whenever you consider a knife to be an expense, what you do, you exaggerate your expenses. And KRA will have a way of knowing that. And when they know that, they will penalize you, they will fine you, and they will add interest on any amount of taxes that you will have avoided paying and filing on time. So to avoid that, always do the right thing, consult where necessary, and as I keep saying, when you know better, you do better.